Chicos, buenos días. ¿O Edgar? ¿Estás tú ahí?
Hola Ana, buenos días.
Ah, eres
Osvaldo.
Osvaldo. Te iba a decir Alfonso, pero no. Dije, ¿de dónde saqué Alfonso? ¿Cómo ves?
Voy a poner la sesión de prueba en lo que llegan. ¿A qué hora se empieza tu sesión? Discúlpame.
8:30.
Ah, perfecto. Bueno, finalizo sesión de prueba. Empiezo la grabación en 3, 2, 1. Listo.
Good morning, good afternoon, everyone. Welcome to another EY LATAM transaction tax webcast, this time focused on sales, carve-outs, and business spin-offs. I'm Cristian Sepúlveda, and it's a pleasure to introduce our panelists today. Enrique Ríos from Mexico, Enrique Nicolás Vázquez from Peru, Patrick Seixas from Brazil, Alexan Unjan from Colombia, Sergio Cabejia from Argentina, and Antonio Ruiz representing Central America. As always, we welcome any question or comment you may have through the chat. We will address those we are able to during this webcast. Otherwise, we will contact you directly after the session. The agenda for today includes a quick overview of the M&A landscape in Latin America and two panels. The first panel will cover some tax topics related to sellers' pre-closing reorganizations, carve-outs, and sales. And the second panel will dive into indirect transfer considerations. After that, Sergio will deliver some closing remarks, and with that, we will be concluding this webcast in about 1 hour. So, in 2024, we saw a decline in both the volume and value of transactions. Volumes dropped by 20%, or 18% according to the just released data to November 2024, and values decreased by 11% compared to the previous year. According to the latest data, this is a 9% increase compared to November. And basically, this is due to macroeconomic and geopolitical challenges. However, there is good news. The market expects a boost in global transaction flow, which should help reactivate mergers and acquisitions in emerging countries. Brazil remains the leader in M&A activity in the region, which is no surprise, followed by Mexico and Chile. Colombia, Argentina, and Peru also play an important role of the total deal activity in Latin America. The US is the top foreign investor in Latin America, while Brazil and Chile are the leading countries investing abroad. Last but not least, technology is still, according to this data, the leading industry sector across Latin America for M&A transactions, followed by real estate and banking. And if we go to the next slide, Juan, please, looking ahead, the view for M&A in Latin America is generally positive, driven by improved economic conditions in the US and geopolitical shifts. In this context, our latest EY studies show that a significant number of CEO plan to acquire companies, but an even larger percentage, plan to divest to refocus on core operations or raise capital for investments. Recognizing this trend, this webcast aims to address some of the main tax issues affecting divestments of different kinds in our region. With that, I think we are ready to start with our first panel. So please, Enrique, Patrick, and Antonio, join me for this first breakout. Once a decision to divest has been made, it's crucial to evaluate the tax risks and opportunities associated with the proposed structure for the seller, also taking into account the effects for a potential buyer. Typical aspects we analyze here are, for example, how tax attributes are affected by the transaction, the risk associated with structures that may be considered aggressive by tax authorities, the effects, of course, in terms of capital gain, VAT, and other associated tax costs, and eventually, for example, the need to support prices with third-party studies. Tax reforms across our region and the increased audit activity by tax authorities make this analysis essential for every share deal, asset deal, carve-out, or business spin-off. For example, in Chile, and as some of you probably know, a tax reform focused on transparency and compliance was recently enacted, which might impact divestments and pre-sale reorgs. Time doesn't allow me to cover everything, but I want to highlight 2 key points. First, the IRS appraisal powers and the tax-free reorg rules have been updated, including transfer pricing concepts and covering cross-border restructuring, which previously was only addressed by specific rulings. Here, I would like to emphasize that the new provision expressly allows taxpayer to present valuation reports to support prices agreed during an IRS audit. In fact, the importance of such reports, of third-party valuation reports, in intragroup transactions, and even in transactions with third parties as indirect sales, is a trend across our countries in LATAM, and you will hear about that in this webcast. And the second aspect I want to emphasize is that in certain circumstances, reorganizations may now be looked through and classified as asset sales for VAT purposes. In the original bill, the tax reform bill, there was this special anti-avoidance provision that allowed sale of shares be reclassified as VAT subject in case the fair market value derived in 50% or more from fixed assets, and the deal was structured to avoid taxes, basically. This part of the provision was finally not passed, but another section was, which allows the IRS to look through reorganizations primarily intended to avoid paying VAT. The provision finally passed presents some technical problems in our view, and its relevance is unclear, especially considering that we do have a broad guard provision in place. However, this highlights the importance of analyzing business reasons and the economic substance of transactions in any divestment process. And again, this is, of course, not only applicable to Chile. I understand, Enrique, that recent changes in Mexico, for example, are making exit structures more challenging, precisely because of these aspects. Can you tell us a bit more, Enrique, about what's happening in Mexico?
Yes, Christian. So I think in Mexico, with respect to divestitures, and this is whether you're doing are facing sort of an asset transaction or a stock transaction. Sort of the first key issue is that with the introduction in Mexico of mandatory disclosure reporting obligations, which requires the taxpayer or the tax advisor to disclose certain transactions if they meet certain hallmarks and requirements, but it's an obligation to highlight the transaction openly to the government. And also the introduction of anti-avoidance rules, which not necessarily focus on just business reason, a commercial rationale behind the transaction, but also sort of a testing that whatever economic benefit derives from the transaction exceeds the tax benefit that you would have achieved. So that is putting a lot of pressure on transactions. And again, this applies whether you're doing an asset deal or a stock transaction. The second one is that, and this is more sort of the considerations that we face on the buyer side, which impact as well sort of the seller's position, is that if you're doing an asset deal, there's a successor liability due to a deemed transfer of going concern. So the buyer would inherit certain responsibility with respect to historical tax issues. And if you're doing a stock transaction, sort of the buyer does not necessarily sort of face that because they're essentially buying the company with all this history. But the key thing that's putting a lot of pressure on divestitures is that the entity that's being transferred can have a responsibility with respect to the seller's capital gains tax. So that is definitely putting a lot of transactions, and whether you're facing sort of a domestic transaction or where one of the parties, sort of the buyer or the seller, would be a non-Mexican that let's say that requires that anything that is to be done with respect to a divestiture, a pre-closing reorganization, needs to be very carefully analyzed and supported with a business rationale.
Thank you, Enrique. And moving to Brazil, Patrick, which are the main tax considerations that sellers should keep in mind when conducting this sort of pre-sale reorgs and exits in Brazil?
I think you're on mute, Patrick.
Yeah.
Thank you, Christian. Thank you for that. So for Brazil, we have many aspects to be considered, especially in the moment we are living in on the M&A market in Brazil. We have many companies thinking about divestment, private equity is thinking of exit strategies, and also corporate client thinking about focusing on their core activities. So first of all, we should understand whether it makes sense to perform an asset deal or a share deal on these transactions. And this may generate different implications, which may be very relevant. Let's take, for instance, an asset deal. If we consider an asset deal, we can have taxation on stocks, for instance, on let's say on inventory. There are some exemptions on real estate, but it's something that usually sellers structure this in a way when they think about an asset deal, trying to avoid VAT taxation on the transfer of inventory. So we can structure a way in which there's a transfer of going concern, for instance, to a new company, and then the buyer may acquire this new company only with the going concern transferred already. Thinking about stock deals a little bit, what are typical implications that we usually see on the market. First of all would be whether it makes sense and what is the scrutiny of tax authorities when sellers perform, let's say, a pre-selling reorganization. It happens a lot. We've seen corporations that are shareholders of a company that will be sold trying to, let's say, perform pre-closing reorganization, so the sale is made by an individual person. This has been subject to many questionings and attack by tax authorities because it has been understood as a pre-organization only focused on reducing the capital gain taxation. Just for comparison, if we think about capital gain taxation of a company in Brazil, it usually follows the general rule, so a 34% rate. And when compared to an individual company selling assets, we can consider a 15 to 22%, 22.5% capital gain taxation. So there's a huge difference there. So sellers should avoid reorganizations only focused on selling immediately after, because this is typically subject to scrutiny by tax authorities. Another key discussion that usually affects a lot the sellers, it's not related to reorganization, but something that we have been seeing affecting valuations a lot, is the negotiated EBITDA for the valuation of a company usually is not considering on the seller perspective what are the impacts of the tax reforms that are coming. So on some tax modelings that we are making to clients, we have been seeing that usually when a seller performs a tax modeling to see if the future EBITDA after the VAT tax reform in Brazil will increase or will decrease, we have been seeing that depending on the sector, there will be an increase on the EBITDA generated by this company going forward, because there's a broader tax basis criteria and so forth. So this is something to be considered, and usually it's not on the seller's agenda, performing a VAT modeling to see if there is any EBITDA to be captured as part of the valuation of the company. This is very critical nowadays, especially because we're 1 year ahead of the beginning of the tax reform. And finally, thinking about succession of liabilities. In Brazil, we don't have, let's say, a silver bullet to avoid tax succession for a buyer, but thinking on a seller's perspective, what may happen is where, in case the sellers want to just dispose of part of its activities, part of its going concern, it can consider moving to another company part of these assets. And this will help a lot on the negotiation of the reps and warranties of the SPA, because based on Brazilian succession rules, if the seller continues its operations going forward, continues having cash capacity, it should remain partially liable for taxes of the past. So although this seems to be not a, let's say, not a favorable disposition for the sellers, it may help a lot on the negotiation of reps and warranties, because this may reduce the level of representations, the level of escrows indicated on a typical SPA on Brazilian deals. There's a lot to talk, but based on the time we have, this is, I would say, the key tax points in Brazil.
Interesting. In Chile, we have this successor liability rule, but it's really not applied in practice by the Chilean IRS. So and moving to, and thank you, Patrick. Moving to Central America, Antonio. Each country is of course different, right? But from a general point of view, what can you tell us about pre-closing reorgs? Are they frequent in Central America? What are the normal risks identified in these processes?
Yes, thank you, Christian. Yes, similar to the rest of the countries in Latin America, in Central America, from Panama to Guatemala and Dominican Republic, pre-closing reorgs are very commonly used. Having said that, only Costa Rica, Dominican Republic, and Honduras has actually specific tax-free reorg provisions. In the case of Panama, we have done several reorgs, but using specific provisions for mergers and spin-off, where the law basically says that those type of transactions under certain circumstances should be tax neutral. Generally speaking, most of these provisions basically establish that the reorg has to be in accordance with the tax neutrality and business continuity principles, but most importantly, there has to be a valid business purpose. And to give you an example of in Costa Rica, the tax-free reorg provision is very recent. It was approved in 2019. We don't have case law, but we have several rulings where, and I'm going to comment on a recent ruling filed by a taxpayer where the taxpayer was trying to carve out the intellectual property from the commercial and manufacturing business and to put it in a holding entity outside of Costa Rica that forms part of the overall group. And the taxpayer defended the valid business purpose, saying that he wants to protect the trademarks basically from the rest of the businesses. And the authorities basically responded that doesn't was enough substance to justify the reorg. And the authorities have been very, very restrictive in some other countries, like, for example, Dominican Republic. In the prior years, in Dominican Republic, we carried out a lot of pre-closing reorgs, and Dominican Republic has indirect transfer of shares taxation. And based on that, the tax authorities issue a recent directive stating that the tax-free reorgs only apply to Dominican entities. So you cannot include in a pre-closing reorg a foreign entity as part of the overall transfer of assets. That's a very, very important change that is putting in trouble a lot of the pre-closing reorgs in Dominican Republic. And also, they said that even in the case of Dominican entities, the reorg can be applied when between two entities that already have operations. You cannot basically set up an SPV in Dominican Republic to transfer assets. The entity needs to have a certain amount of time operating. So those are like examples of how the authorities have been restricting the use of the pre-closing transactions, and that's why the taxpayers and the buyers have to be very careful about the use of to review the pre-closing transactions before entering into a transaction.
Thank you, Antonio. Thank you, Antonio. So as you can see, there's a lot happening in our region with some common trends as the increased importance of valuation reports and the substance over form approach in our provisions and in the IRS audit activity. So here my main takeaway is to address tax aspects early in the process, especially now with tax reforms spread across the region. And as mentioned, tax authorities increasing their audit activity. So with that, we conclude our first panel just in time. Thanks, everyone. So over to you, Sergio, with our next discussion.
Sure. Thank you, Christian. Hello, everyone. It's good to have you here. We have with us today our partners here in Peru and Colombia, Nicolas Vázquez from Peru and Alex Anuncian from Colombia, and we will try to address all of tax considerations around indirect transfers today. As a way of introduction, let me share with you that that the business world continues to increasingly focus on efforts on innovation and specialization, actually. As mentioned by Christian, this evolution is largely based on the advance and development of new technologies. Only those who can generate value efficiently will succeed in the current and future markets, right? Consumers, by the way, are becoming more demanding, creating the need for greater capital investment in the core business or main business, right? In this scenario, many companies from various economic sectors are forced actually to divest business units to allocate more capital to the main business line. This context largely explains the boom that Christian was referring to of spin-offs and carve-outs. Both multinational and national groups seek to divide their business areas and prepare them for subsequent sale, or what is also feasible, for the entry of an investor or loan facility that allows for more efficient and competitive development of the activities. Let us remember what the OCDE has already defined in numerous presentations and documents, that shortly the entire global economy will be digital at some point. In this context, we are more and more seeing carve-outs and spin-offs of different business units, and such separations imply, of course, significant tax consequences. And today we will focus on indirect transfers, which is a common way for multinational enterprises to separate different businesses, to prepare them for a subsequent transfer or attract new partners or loans, right? We will now begin with an overview of recent changes and indirect transfers, and the use of tax treaties, which is a particular issue that we want to emphasize here. To begin with Argentina, let me start by the recent changes. In fact, in historical terms, it's recent, but in 2018, the former President Macri's administration began to tax indirect transfers. It must be informed that prior to such date, 2017 backwards, indirect transfers were not taxable in Argentina. So as from 2018 onwards, indirect transfers began to be taxable, but under specific requirements that must be fulfilled simultaneously. The first one being that shares or participation sold must represent 10% or more of the foreign sold entity at the moment of the transaction or in prior 12 months. And simultaneously, 30% or more of the fair market value of the foreign sold entity must be represented by the Argentine entity. So if the Argentine asset is larger than 30% of the entity being sold abroad, then the indirect tax rules apply. But there are two particular exceptions that I wanted to raise here. The first one is that there is a grandfathering rule. By grandfathering rule, I mean that prior, as I mentioned, prior to 2017, indirect transfers were not taxable. So by this grandfathering rule, all structures in place prior to 2018 that are being disposed of after 2018 still are not subject to tax. So the ones that are subject to tax, conversely, are those indirect transfers which shares were actually bought or structured after 2018. So we have, let's say, two sets of rules working at the same time. For those whose structure is before 2017, the first transfer is not subject to tax. Those who structure their model after 2018, those become taxable. And also there is an intra-group relief. So indirect transfers performed within the same economic group are not subject to tax. There is a particular excess, I would say, in the regulatory decree today that says that those intra-group transfers would be exempted provided they were structured prior to 2017, which in my view is an excess with respect to the law, because the law doesn't make any difference on that in that front. But the rest of the issue that I wanted to raise here is related to tax treaties, because based on current tax treaty network between Argentina or among Argentina and other countries, there are specific treaties which, under a reasonable interpretation, lead us to conclude that indirect transfers would not be subject to tax. Please bear in mind that tax treaties have, in Argentina, have constitutional level, so they override the domestic income tax law. So if the treaty provides for an exemption, then the capital gains tax is not applicable. And this is the case for the Netherlands, for UK, for Mexico. There is much audience from Mexico here, and Italy. These treaties provide, and many others from France. But these treaties provide for an exemption on indirect capital gains tax. So I would suggest to analyze them if you are planning to divest an Argentine subsidiary in the future. Having said that, I want to pass the word to Nicolas, and in order for him to address some Peruvian consequences. In fact, my questions, and I would make the questions directly, and in order for Nicolas to elaborate more in detail. The first one is, what is the current local tax regime for indirect transfers of Peruvian shares, and what tax reliefs are actually available under Peruvian double tax treaties? And also, what recent criteria have been developed by Peruvian tax authorities, and considering both local law and double tax treaties, and what changes can be expected in this regime in the near future? So the floor is yours, Nicolas, please.
Thank you, Sergio. I'm happy to be here with all of you. So basically, the Peruvian tax law currently establishes that indirect transfers of Peruvian shares are subject to the Peruvian non-resident capital gains tax if one of the following scenarios is met. The first scenario requires that the fair market value of the non-Peruvian entity that is being directly transferred derives 50% or more from the fair market value of the Peruvian subsidiaries or subsidiary that is being indirectly transferred. I think this requirement is similar to the one you commented, Sergio. And there's a second condition, and it's that the seller should transfer at least 10% of the shares issued by the non-Peruvian entity that is being directly transferred. If this first scenario is not applicable, we have a second scenario, which establishes that the transaction may be subject to the Peruvian non-resident capital gains tax in Peru if the value attributed to the Peruvian shares is equal to or higher than 40,000 Peruvian tax units, which are equal to approximately $55 million. So if any of these scenarios is met, the transaction will be taxable in Peru with a 30% non-resident capital gains tax. However, this rate could be reduced to 5% if the transaction is executed in the Lima Stock Exchange or the Peruvian Stock Exchange. It should be noted that in Peru, there are specific provisions that regulates how to estimate the fair market value to determine whether the transaction is taxable in Peru or not. And we also have several provisions that regulates how the tax basis or the cost basis should be determined, and also in some cases this tax basis should be certified with the Peruvian tax authority before the transaction takes place. In addition, it is worth mentioning that there is no tax neutral or tax deferral regime under the Peruvian local tax law for indirect transfer of Peruvian shares that arises from corporate restructurings. So this means that all indirect transfer of Peruvian shares are taxable in Peru if the previously commented scenarios, if one of these scenarios is met, regardless that this indirect transfer derived from a third-party transaction or from an internal restructure, which is not ideal for internal restructurings. So moving forward, we do have a very limited treaty network in Peru. We only have 9 treaties as of today. Basically, we have treaties with Brazil, Canada, Chile, Japan, Korea, South Korea, Mexico, Portugal, Switzerland, and the Andean community. For majority shareholders, there is full tax relief only in the treaty with Canada, because the treaty with Canada establishes that if the fair market value of the non-Peruvian entities that is being directly transferred does not derive 50% or more from non-operating immovable property, the transaction is not taxable in Peru. And it's important to mention that we only consider non-operating immovable property to estimate this threshold. So any operating company, it is likely that this tax relief will be fully available when there is an indirect transfer of an operating company in Peru. This is the only full tax relief under the treaty with Peru and Canada, and is available for majority shareholders and minority shareholders. We have, in addition, a partial tax relief under the treaty with Switzerland, because the rates could be reduced from 5% to 2.5% if the transaction is taxable in Peru and is executed through the Lima Stock Exchange, and the 30% rate, which is the standard rate, could be reduced to 15% if the transaction is not taxable in Peru. And the condition to apply these reduced rates, if the seller is a Swiss resident entity, is that the target entity should not be a real estate entity for purposes of the double tax treaty, which means that its value should not derive from real estate assets located or situated in Peru. On the other hand, we also have a full tax relief for minority shareholders that owns less than 20% of the target entity under the treaties with Portugal and Korea. And the condition, again, is that the target entity should not be a real estate entity for purposes of those treaties. Finally, for completing purposes, there is no tax relief available under the treaties signed by Peru with Brazil, Chile, the Andean community, and Mexico. And in the case of Mexico, it's debatable because some people may argue that there is a partial tax relief or a full tax relief, for minority shareholders. But some people consider that even though that could be argued, there's a high risk that the tax authorities will challenge the application of the treaties in that specific case. So that's like the landscape under the local tax law and the treaties network signed by Peru. Moving forward.
Okay,
yeah.
Go ahead.
Just to complete, 2 items that are currently being discussing with the Peruvian tax authority. The first one is that we used to have an opinion from the Peruvian tax authority dated from 2021, indicating that indirect transfers of Peruvian shares when the seller was a Chilean entity and the target entity was a Chilean entity and the entity beneath them was Peruvian, of course, that transaction was not taxable in Peru due to the application of the treaty. However, 2 years after, in 2023, that criterion was completely changed and the Peruvian tax authority reversed its position, indicating that the transaction will be taxable in Peru. So this criterion has created a lot of issues for several taxpayers because rulings in Peru are not binding. It's basically an interpretation of the Peruvian tax authority to a specific rule, and that interpretation could be amended as the time moves forward. So this is, I would say, the major issue being discussed regarding indirect transfer of Peruvian shares, considering that double tax treaty reliefs. In addition, there is a different item that is currently being discussed, which basically is how to estimate the immovable property threshold to apply the relief provided in the double tax treaties. So what is being discussed is whether we should compare the immovable property versus the entire assets or the value of the shares. In our opinion, we should compare the immovable property assets with the value of the shares. But in the opinion of the Peruvian Tax Authority, we should compare the value of the immovable property with the value of all the assets. A second discussion in this regard is whether the comparison should be made considering the book value of the assets and the shares or the fair market value. So those two topics are currently being discussed at the level of the Peruvian Tax Authority. One of them has already been raised to the level of the Peruvian Tax Court and has already been resolved, but this is something that it is not certain as of today which will be the final decision of the authorities in Peru. And the expected change for the upcoming months is basically Peru will sign a double tax treaty with the United Kingdom, and it is likely that it will be published soon. And Peru will start negotiations with China and Spain to sign a double tax treaty also in the upcoming months. However, it is uncertain whether these double tax treaties will include a tax relief for indirect transfers of Peruvian shares. A second hot topic is the MLI of the OECD, right? This cross-border multilateral instrument, it's intended to modify the entire treaty network of several jurisdictions. In the case of Peru, when the MLI enters into force, there will be no tax relief under the double tax treaty signed by Peru and Canada. So when this happens, there will be no full tax relief for minority shareholders in the case of indirect transfers of Peruvian shares. And that's it. Sergio, I don't know whether you have any questions.
No, what I would say is that the audience here, the issue related to real estate rich companies it's a subject matter in particular that must be addressed, as you mentioned. Same happens with Argentina. I did not mention this in my speech, but certainly real estate rich companies usually are not covered by the double tax treaty exceptions. So this is something to, of course, bear in mind when planning these transactions. And this gives me the chance to move on to, and thank you, Nicolas, to move on to Colombia, to Alexan. Alexan, I understand that Colombian tax authorities have provided guidance on the application of the regime, focus on value allocation and tax basis, actually. And recently issued guidance on the application of the indirect tax regime in the context of the double tax treaty. Can you share how this impacts the approach of this indirect tax regime? And also, what key factors must be observed when disposing indirectly investments in Colombia?
Sergio, thank you so much. And so happy to be here once again, sharing with you different ideas, thoughts around what happens on the transaction tax landscape. For Colombia, it has been a really interesting year because we are now in the brinks of a new tax reform, which is no surprise there. But we have recently received good news from the tax authorities on guidance, as you mentioned, on indirect transfers. So the indirect transfer regime is something that is, let's say, quite recent in practice, in the sense that we have not had that much target practice in the application of the rules and not much guidance around it. Most of it has been focused on how the revenue recognition is and how the cost analysis is when you have different indirect payments, payments derived from indirect sales, in which the payments are done in installments or there are adjustments to the prices depending on how those SPAs fall in place. Now, we have a lot of focus on substance, and I'm probably going to share a couple of thoughts there, jumping from Nicolas's points. But what is interesting is our regime on indirect taxes starts with a general rule, basically a catch-all that says everything is subject to indirect tax. Any type of indirect transfer is. So when you start with that, then you have a couple of local fallout rules in which you basically have exceptions. And those are based on the value of Colombia, value based seen as book value, as of the whole that is being transferred, and value seen as fair value. And on those terms, we're going to share a couple of thoughts there. But we have always had these discussions, and start specifically on Nicolas's point, we were missing the position that the Peruvian authorities had in 2021, because it was really unclear whether, if you have a structure in which you have, let's say, a Chilean company that has another subsidiary in Chile or in another country, and then that subsidiary owns shares in a Colombian company, if the Chilean company on top transfers directly their ownership on that subsidiary that they have, indirectly transferring Colombia, would that be taxable or not? So under the indirect tax regime, the answer is yes, it is taxable unless you fall into the general exceptions. But the treaties are not very clear on whether they cover indirect taxes. They're not meant to do so. But when you look at Article 13, sometimes 14, but mostly 13 on the Treaty on Capital Gains, you have certain paragraphs. And if you look at the fifth paragraph or fourth, depending on which treaty you're looking into, you have a catch-all that says, in all other circumstances, so you have four specific items, then in all other circumstances, then only the residence country has the right to tax. So in the example that I am providing, where Chile, let's say 1 sells Chile 2, but owns indirectly Colombia, then does that fall into one of the other items, or is it taxable for the indirect tax regime or catch in the treaty? So the interesting thing is the authorities issued a month ago, this is November 20th of this year, actually picking this idea in which they say, well, the other sections of the treaty, or the other paragraphs of the treaty, are basically covering land-rich circumstances and direct sales. So it's the direct disposal of ownership in Colombia, not the indirect one. The indirect would eventually be covered elsewhere, other type of revenues. But if you're disposing of shares, meaning it's a capital gains under the treaty, and you need to go through the treaty interpretation and application of revenues, then you fall into that paragraph 5, in which, well, if it's Chile selling Chile, or let's say UK selling Chile or Mexico, etc., then it's not a direct sale. And because of that, the tax authorities just recognized that Colombia does not have a right to tax. It is a, let's say, local operation for a treaty company, and therefore the indirect regime will not apply, specifically because the indirect regime was, after several draftings, picked up a rule that says that the indirect tax regime respects and is subject to the conditions of a treaty. So with that in mind, then this concept is really, let's say, where Peru was a few years back. Now, hopefully they don't pick up on this 2023 idea and reverse the position, because this is really a technical position which is correct. And we've used it in the past, and for those that have heard me in professional forums or academic ones, you know that I've shared this thesis for many years back. So it's really an opener that we have at this point, which is really interesting. And that also is tied to another opinion that was issued in July of this year, in which the authorities said that the Colombian spin-off regime, so reorganization regime, which is tax-free, is applicable in the context of foreign spin-offs. The condition, of course, is that the definition of a spin-off that is used abroad is also the same definition of a spin-off that Colombia has in nature, not the same rules, but in the application of international private law, then you basically have your rules in which the country that has the spin-off applies. If it's materially in nature the same as in Colombia, then you apply the regime. So when you start looking at the regime that you have in reorganizations, tax-free organizations, that use of treaties, then indirect transfers becomes a tax-efficient approach for structuring deals. The key here, and I'm going to jump to the second part, is what do you need to be mindful about? And number one is substance. You need to prepare for a transaction, and you need time for that sometimes. So when you improvise and let's say you reorg and dilute a company or try to do, treaty shopping type approaches, at that point, then the whole structure that you set up falls down. And you need to be mindful because the successor liabilities capture the company that is being indirectly transferred, and that Colombian company becomes jointly liable with the seller and eventually with the buyer too. So there are specific rules there that we need to be very careful about. And the other portion of the story, and this is very important because of course it's much better to be covered or protected in indirect taxes with a local rule and then have the additional protection of the treaty. And you need to run those tests. The 20% ownership test, more than ownership test, is the 20% value test that Colombia has, book value and fair value. Both tests need to be met. Now, when you talk about fair value, you need to be careful here because we've seen a lot of cases in transactions when you have an international operation that sells and Colombia is one of the companies that is being disposed of indirectly, then you have a valuation assigned to different countries. And we had the discussion with Peru too, and this is something that we've recently talked with Nicolas and other colleagues here. When you do a valuation top to bottom, so you start and say, okay, the whole company and business is worth X, and you start allocating value down the chain. If you do the exercise down up, normally there are gaps. And the part that you need to be very, very careful about is the local authorities will look down up. So it's bottom up that's factor for them. So you need to be mindful of doing so and make sure that if there are gaps, you have justifications, because you don't want to be caught up in discussions on taxation based on whether a discount rate is the correct one, whether the risk factor is the correct one, because there becomes a financial discussion and subject to many, many interpretations too. So we have a very interesting regime. The authorities have set the stage for a business-friendly approach as long as you do things properly. So do prepare, analyze things with time, be mindful of EBITDA impacts, the valuation of the companies and the valuation of the operations. And definitely to your point, Sergio, on real estate and land rich companies. And this is really important, especially for the energy sector, solar panels, solar plants, and these that have a really interesting discussion of what is understood as real estate and what's not. So this becomes relevant because land rich gets captured with treaty provisions. So you lose the protection, therefore you get caught with the indirect tax regime too. So you need to be careful about this, but it's definitely doable. So if you want to talk about this more, this is a passionate subject for all of us here, and definitely a strategic subject when you are planning on invest or divest. So happy to be on these discussions and on the investment of things as they happen.
Sure. Thank you, Alex, and very much. I think that both interventions were really insightful. I would say that both of you touched two main topics that I think eventually might be a good opportunity to tackle them in the next sessions. One of them being land-rich entities and how they are treated by tax treaties. And the other one is foreign reorganizations and how they impact the source countries. These two elements, I think, are very interesting to elaborate a bit more in the next sessions. Thank you very much, and thank you both for your speeches. In terms of we are arriving to the final of these presentations. Let me finish up with some closing remarks. As discussed during today's sessions, current and future market conditions are generating the need for innovation and specialization. Investment in technology that ensures the future survival of the business model makes the separation, sale, or alignment of business units fundamental, right? The capital need implied by technological change for global private and public activity is perhaps one of the most significant in history terms. So the necessity to deploy capital to core businesses is leading the multinational enterprises to dispose of secondary business lines or restructure the current legal entity to accommodate new partners or loan facilities. This race for new technologies and consequently for value creation requires a particular approach when evaluating tax implications. Our first recommendation and message to this audience, and this was mentioned by Christian, by Alexan, is that Latin American countries are increasingly seeking revenues. And in this context, thorough, anticipated planning of any movement in the corporate structure or indirect transfers is essential to evaluate alternatives and compare different tax implications. We should not improvise in this arena. And a second piece of advice would be to tackle these restructurings or indirect transfers holistically. This means taking into consideration the tax consequences in the different countries involved and the interaction among them to avoid any unforeseen consequences or tax leakages. I would say that you can see in the slides that there is a QR here that you can use also not only to find this recording, but also you can include there any topics you may want us to tackle during the next sessions. In any event, you will be receiving in January an email from our central team asking for new topics or issues that you want us to raise and discuss during these sessions. I think the more you raise concerns, the more we can generate or add value to you in these presentations. Finally, I want to thank you for your attendance today and extend, of course, my gratitude to my partners who I think delivered high quality insights and inputs during today's session. This is our last virtual meeting for this year, 2024, but we are certainly planning to continue with these sessions in 2025 with your insights as well, addressing new developments in the M&A industry and, of course, legislative changes in the different Latin American countries. I take the chance to wish you all happy holidays and looking forward to seeing you during